RBI Governor Shaktikant Das had flagged the high growth in certain components of consumer loans in October. Das had told lenders to strengthen their internal surveillance mechanisms. He wanted guardrails in place. And last week, the central bank made its move to enhance guardrails and strengthen internal resilience. On 16th of November, the Reserve Bank of India increased the risk weights for consumer credit exposure, including personal loans, by 25 percentage points to 125%. The hike in risk weight implies that banks and NBFCs will need to set aside a higher amount of capital for these loans, leading to an increase in the cost of capital. The adjustment applies to both existing and new loans. However, it excludes housing loans, education loans, vehicle loans, loans secured by gold and gold jewelry, and microfinance loans. Typically, commercial banks and non-banking financial companies, or NBFCs, face a risk weight of 100% for loan exposures. A hike in risk weights may lead to higher interest rates and reduced access to credit for consumers as banks adjust lending practices to meet increased capital requirements. This could impact borrowing costs and limit the availability of loans. It may lead to a rise in unsecured lending, creating room for the emergence of shady loan apps. People are availing far more unsecured loans than they were before the pandemic. The total value of these select unsecured loans rose 93% to rupees 14.3 trillion in August from rupees 7.4 trillion in the same month in 2019. According to credit information company Experian India, digital lending will surpass traditional lending on unsecured loans by 2030. However, the rapid growth in digital lending has also led to the proliferation of shady loan apps over the years. The increase in risk weight may further accelerate the growth of these apps.
Let us say that loan apps now. So now what may happen is the banks and NBFCs will have to put more capital because the risk weightage has been increased. So they will sort of reduce their direct participation in such loans. They'll reduce it, particularly the unsecured loans. In which case loan apps will try and push that credit, and it will push the credit at a higher price. That's one problem. The second problem is if there is any aspect of non-recovery, then they will be very harsh and coercive. So those are the issues associated with loan apps.
Extending your logic, probably we'll see the money lenders also, coming in hordes to fill in the space, provided the demand for personal loans, what we have been seeing, or the rise in demand for personal loan is genuine, because people are, we understand that rural India is not in the best of health. People have lost their jobs, their income has also gone down. So they are resorting to taking personal loans. It's not a luxury loan for them. It's basically to continue with their life. If that is the case, yes, we can see the loan apps coming and exploiting the situation.
In his press conference post the MPC meeting in February 2022, the RBI governor had suggested that digital lending apps are not regulated by the RBI. And in September that year, the RBI came out with guidelines on digital lending. They were based on the recommendations of the working group on digital lending. But it seems that was not enough. Exploiting loopholes, scores of unscrupulous entities are still thriving, and reports of harassment and even suicides continue to pour in from parts of the country. So, what is the way out?
Money is a state subject, that's point number one. And now the central government has showed its concern. RBI has come out with the digital lending norms and redefining it again and again. So I think the best way is, of course, financial education. It's at some point we are talking about inclusive finance and reaching out to people. So the best way, of course, as I said, it's a legal issue. I think it's an issue with the police and the state governments, respective governments need to deal with. But most importantly, we need to have financial education using everything, social media and television channels, each and everything, and making people aware that don't get into that trap.
The responsibility clearly goes to the regulator. So therefore regulator will have to really do something. He cannot stop only at increasing the risk weightages for the banking and for the NBFCs. I'm sure he will take up measures, to save people from going to loan apps, basically.
Business Standard's Tamal Bandyopadhyay also said that RBI had in August recommended formation of a body called DIGITA, or a Digital India Trust Agency, to ensure that only authorized digital lending apps are used by consumers. So once the government accepts RBI's recommendations and establishes Digita, then we will have a certification agency to approve such apps. And then there will be an ecosystem of authorized digital lending apps. But till then, financial literacy and awareness will save people from falling into the trap of shady apps and moneylenders who are likely to fill the void created due to the RBI's move.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's making plans for an early retirement. Business Standard.